If you sold your business tomorrow, how much would you actually keep? Not the headline number, not the valuation. What hits your bank account after deal structure and taxes? Because two company owners can sell for the same price, but one could walk away with millions more. And the difference isn't the deal, it's what happens before the deal. And that's exactly what we're going to cover today. I'm joined by my fellow growth thinkers, Jeff Jones, the VP of Growth Think Capital, and Jeff Sokol from our Registered Investment Advisory Division. And we're going to discuss how you can keep more of your hard-earned dollars after your exit. This is going to be a good one. Take notes, sharpen your pencils, bookmark it, like, comment, subscribe for more content like this. Let's get into it.
I will say in all the webinars we've done, Tim and Jeff, that this topic seems to be the one which is in highest demand from clients and prospects and just people in the industry, generally speaking. And so we've addressed it before, but today we're going to dig in a bit more. Excited to do it. I've been here for a long time, done a lot of transactions, and I will say that this is where clients are least prepared, and looking forward to providing some value there. Jeff, quick intro on your end.
Yeah, my origin story was that I was in business development and operations in private equity, spent a number of years in Asia. The eye-opening moment for me, and when I pivoted into wealth management, was that there were people that seemed more intelligent, more capable, and higher ranking, making more money than I was, just to be blunt, that were doing worse than I was when COVID hit. So it was an eye-opening thing to see you can be a great operator of a business, you can have all that capability in the world, but if you're making mistakes, then it catches up to you quickly. That's everything to do with financial planning, wealth management, and tax strategy. So being here, the marriage of financial planning and merger and acquisition activity is very logical, but
Yep.
not everyone has the skill set, and not everyone goes into the weeds and studies this stuff. So we try to add value by filling in some blind spots and then keeping more of your net proceeds after the transaction.
And there are things we have to do early in advance, Jeff, and things that are during the transaction itself. So again, when you're considering your exit and big liquidity event and pegging a valuation target for the business, right? What is it going to sell for in the market? You must also clearly understand your net proceeds, right? It's not what you sell for, it's what you're going to keep. And a strong, sound tax strategy going in or leading into that exit process can literally impact 20 to 40% of the deal of your net proceeds. And if you're selling the business for 8 figures, that's a lot of money, right? And so everyone's always trying to spend time trying to maximize value in the business, rightfully so, and that's a big part of it. But they're not spending a lot of time actually thinking about taxes. And when they do, the activation of that is through the actual M&A process. And sometimes and we'll talk about this, Jeff, it's too late to apply to those advantages and tools. So the smartest founders are always planning years ahead. And we'll talk a little bit about that in terms of that lead-in time for the specific strategies that you can deploy here. But we're talking about meaningfully elevating net proceeds 7 to 8 figures in as long as you can plan ahead, again, ahead of that liquidity event. The tools and strategies are there. You get informed, you plan ahead, you build the right advisory team, as Jeff was alluding to, and then execute accordingly in advance. So reduce tax exposure, preserve wealth, maximize liquidity. That's all the focus of what we're trying to do here on the banking and wealth management side for our clients. And a few tips here I think you'll be able to gather from the call should help you tremendously. What sellers are actually facing, if you look at the left and the right, the tax stack in a sale of a business and what you're considering, most of you understand this, but then quantifying that for kind of an average deal of a $30 million exit, for example. So federal taxes will be determined by the type of sale, cap gains or ordinary income, asset sale or stock sale, right? Stock sales, you're going to see cap gains. Asset sales and likely ordinary income. So that structure will generally impact your taxes. A net investment income tax, essentially it's a federal surtax on high earners. That could be substantial as well. State taxes vary, right? Where depending where you live, where the business is. If you live in California, like a couple of us, two of us do on this call, get ready for a 13.3% tax rate. If you live in Texas or Florida, for example, 0. So considering that, where the business is, where you reside, could impact dramatically as well. Then you think about depreciation recapture. That's essentially the IRS telling you you already got a tax benefit. Now we're taking some of it back. So at exit, previously depreciated assets, um, deductions must be recaptured. And then ordinary income components like earnouts or consulting agreements or asset sale allocation. So you can kind of see the example of those on a $30 million deal, and taxes kind of consuming a big chunk of that without planning. And so these are the kind of things to consider. So when you start breaking down your exit value, again, modeling out the tax liability ahead of time is critically important when we're talking about tens of millions of dollars here potentially. So that's the overall landscape and the kind of things you should be thinking about. And you might already have some of these thought through or might not, but we'll dig into some of the specifics here in a minute. Let's look at the biggest mistakes here that destroy net proceeds. Coming back to timing, some of these elements and some of these tax tools and strategies should be started years in advance, 3 to 5 years in advance in some cases, which Jeff will talk about. Again, the asset versus stock sale piece around structure is important. We'll talk about QSBS eligibility, holding companies, things of that nature, and ordinary income risk. By the time the LOI is signed, many of these strategies are already off the table, right? If you're waiting too long, and that could mean literally $10 to $15 million in your specific deal. So, again, thinking through that ahead of time, part of our job as investment bankers and wealth managers is to help you understand what that looks like in terms of the outcome well in advance, right? And so talking about this 2 to 3 years in advance at minimum is critical. Waiting until the deal is actually happening, you will lose value. And therefore, you have to plan and try to really negotiate a better deal at the end of the day, which might be completely out of market and unlikely. So don't put yourself in that situation. And Jeff, you're going to dive into some strategies that people may be aware of, might not. And, okay to get a little technical here as well, but floor is yours.
Just want to give you some insight into a few of these different options, starting with qualified small business stock, which is a $15 million tax exemption per taxpayer. So what I mean by that is, let's say if you wanted to combine a few of these strategies, like we're looking at pre-sale gifting and family transfers in the middle of the slide, if you use a spouse or children or others who you're close with, other close confidants, you can get a higher exemption. To put some numbers on this one, qualified small business stock, it depends on the type of business that you're operating, and it does have to be a C corporation. One thing we'll run into a lot here is the owners or the operators will say, well, C corporation is going to be taxed at a higher rate, so I don't even want to deal with that. Then it gets into scenario modeling. So the important thing here is, just to give it some numbers again, let's say you're paying yourself $100,000 and you're going to be in a 10 or 20% higher effective tax bracket. So on a $100,000 salary, you're losing $10 or $20,000 more. But we restructure it, and then we sell this thing for 20 or 30 or 40 or $50 million in 3 or 4 or 5 years. Then those net proceeds being at a 10 or 20% lower effective tax bracket, that scenario makes it obvious that over time you're going to benefit from a restructure. So, this is the idea of understanding what trade-off that you're making. 3 to 5 years, it's an important distinction, because with the one big beautiful bill, it used to be all or nothing. You had to do a full 5 years. Now you can get up to 50% of the benefits at 3 years, 75% at 4 years, and 100% at 5 years. So we'll stop on that one. We may have some questions about that one later. It's always popular. The pre-sale gifting.
Jeff, sorry. Mm-hmm. Yeah, real quick on this too. The one thing we talked about, asset versus stock. Yes. The transaction in terms of eligibility needs to be a stock deal. And again, as a seller, there are, sometimes that's a negotiable piece or not, and that's something to consider as well. Jeff, it's a big requirement when coming into, the deal process.
Yes, I'm glad you mentioned that, because the reason why we're going to highlight 6 different options here is that the more you know on the sell side, the easier you can pivot once you have these buyer conversations. Like if you have all your eggs in one basket and then the buyer makes you a different type of offer, you feel like you're lost. But if you
Right.
know all of your options, then you're quickly able to pivot and still know that you can achieve what you want to post deal. Okay, so then on the transfer component, and we're talking about trusts here as well. Some people in the audience may have heard the idea of a charitable remainder trust. What you can do here is you're designating some of the assets into the trust, which has a charitable component, and then the IRS is going to give you tax relief on that portion of the sale. So let's say 50% of the assets go into the trust, and it's a $10 million sale. Then that 5 million is now deferred from taxation. And then you can pay yourself in income from that trust for the remainder of your lifetime. You can draw down the assets like by 5 or 7%. The point of doing this is that you cover your short-term liquidity needs with the portion that comes out right away, and then you defer the taxation on the rest of it, so you have a larger principal amount that will allow you to have a larger income for the remainder of your lifetime, and puts you in a lower tax bracket. Opportunity zones. This is kind of the a very salacious opportunity, as we like to call it, because this doesn't require you to do much in terms of the planning. You don't have to bring in the tax attorneys and the lawyers and the advisors per se. What you can do here is you take your capital gain and you redeploy that capital into an opportunity zone. That reallocation, it makes the capital gain exempt from taxation. And if you hold your assets in the opportunity zone for the full 7 or 10 year period, you're never taxed on the original capital gain or the distributions from that investment vehicle. So this is a very attractive idea. You have to know the best general partners and people who have a full-time focus in this asset class.
Mm-hmm.
Because this is not the same thing as like, okay, I want to redeploy into NASDAQ stocks. This is a very specific underwriting process and analysis process to figure out which opportunity zone is actually going to get you paid. But it can be a very powerful investment type to use. Okay, so a rollover, this is what Jeff Jones and his team would often describe as having 2 bites of the apple. This doesn't necessarily feel like a tax break, because this is when you sell a portion of the business is liquid now, and then a certain percentage is kept in the business that can be earned out over time. But this is where the more you know, the more information that you have, you might realize that this rollover opportunity allows you to structure the sale into an installment, or if the entity is going to be restructured from a certain type of corporation into a C Corp, then maybe you become eligible for qualified small business stock on what's rolled over. So this is where you just have to be strategic and understand what the buyer's offer is, and then how you can maximize those proceeds over time.
And one thing on rollover equity, Jeff, too, that just so we're clear, everybody, that in the transactional world these days, M&A, that oftentimes there isn't going to be a full cash deal, right? If you sell your company for 50 million, sometimes you'll get 50 million, but normally now there are the structure scenarios involved, such as rollover equity or installments. And the rollover, the equity piece is essentially saying, okay, you're going to get 80% of this deal cash at close, and you're going to roll 20% equity into the new entity or the existing company that is the buyer. And that then retained equity is tax deferred, right? That's essentially the strategy. And same kind of thing with installment sales that work well with different types of buyers. Could be family offices or search funds or recapitalizations, where that liability is spread over time, right? To your point. So important, because again, as a seller, you need to understand that coming to the table, it's unlikely you're going to see a bunch of full cash at close type of offers. And so this might be built in and you have no choice.
To spread out on the installment sale, just to put some numbers to it again, you might save the net investment income tax of 3.8% in an installment versus receiving it all up front. So let's say it's $10 million over 10 years. That 3.8% suddenly is very meaningful. It's $380,000 that you would save.
Yeah.
So these are little tweaks where you see a small number and you feel like, what's the big deal? But as you model these numbers out and you can see it in front of you to understand what your liquidity looks like, it's very meaningful. And then this last one on pre-exit relocation is a hot topic. We're
Who's your
looking at,
favorite one, Jeff? Who's your favorite one?
yeah. Well, I love talking about it, and then the irony of living in Southern California, which I'll probably
Right.
continue to do for forever. So I'm all talk, I'm all bark and no bite. But if I was having $100 million exit, then suddenly I might be able to convince myself that those zero
Right.
income tax rates of Texas or Florida might become more attractive. You just want to be careful here because the state is no fool. They know what you're doing. You can't just, decide to move tomorrow and sell a week from now. There's clawbacks and there's other provisions that would prevent that from happening. So you have to do this legitimately. And then we think probably give it a couple years ahead of the actual transaction to start mapping this out so that you don't get in a situation where you're trying to save taxes so much that you end up either getting audited or the business struggles as a result. But all worth thinking about because you change a few percentage points on $100 million deal, it's extremely meaningful. So we like having these conversations early and often and making sure we're all on the same page and that you can live happily ever after post deal.
Indeed. And the relocation theme is goes far beyond M&A, right? Where you have a lot of the high earners in different high tax states migrating to low tax states, right? For these specific reasons. So that's a big planning one, right? That you probably need to have a conversation about early on, but definitely takes out chunks of the net proceeds. Very good. So again, a bit more technical here and some of the strategies, and we're happy to go into these more at length with one-off conversations. But things that you can now start thinking about, you can search for and have conversations with your advisors about as you're thinking about that potential exit plan. On the next slide here, Tim, that we've kind of touched on this a bunch, but this is one area that you plan for, but is going to be kind of a talking point or a deal point within the process with a potential buyer, which again is the asset versus stock sale scenario. So, the deal terms matter when how it impacts taxes, right? We talked about some of those, but buyers prefer asset sales for various reasons, right? They have a huge advantage from a tax perspective because they receive a step up in their tax basis, which means they can depreciate and amortize assets again over time. That's a big deal. They also avoid some hidden liabilities like legal issues or employee issues or any disputes you have with contracts or customers or anything else, right? So it's more of a clean slate for a buyer, but that then as a seller, you drop back into the ordinary income bracket versus a capital gains scenario on your taxes. And so that matters, right? And so the buyer wants to buy the business, not the baggage. That's essentially an asset sale. However, from time to time, we can negotiate in stock sale scenarios instead. And that's going to be much more tax efficient for you as a seller. Now, the buyer might carry more risk. It depends on the type of the business, but it is something that can be a negotiation point, during the process. So again, and as Jeff mentioned earlier, to qualify for the big one, the QSBS, the transaction must be a stock sale. So, structure matters in these deals. And here's one big one that can result in just good, strong negotiation with your buying partner. So moving on to the next here. So wanted to kind of, again, quantify things, right? When we kind of bring this together full circle, if you look at two sellers, same price, very different outcome around scenario A, which essentially is no planning. And you kind of look at average scenarios around, all of the tools we talked about. That's a big chunk out of the deal. I think most people anticipate that scenario, where versus a scenario B, we apply maybe some QSBS federal exemptions. We look at rollover equity structures, some pre-sale gifting and trusts, as Jeff mentioned, and all of a sudden you have a $9 million delta, right? That's insane. And that's generational wealth alone for a lot of people, let alone that $34 million in net proceeds. So, very, very important things to consider when you're actually planning around the exit scenario, and the tax mitigation part is absolutely huge. And then putting numbers to it. So if you come to the final slide here and kind of wrap this up, and again, planning should involve your advisors. And when you think about optimizing the situation and the outcome, we've said this in other conversations and webinars, and it's very, very important. We think of this as kind of the four-legged stool, your advisor coordinated team when you're prepping for an exit of your business. Obviously, the M&A advisor, the investment banker that's represented by me on this call, your wealth advisor represented by Jeff on this call, which is kind of straddles the tax mitigation piece as well. But you always got to include your tax and CPA expert alongside your estate and M&A attorneys to help coordinate this and make sure you're in the best possible position. And then just a quick checklist to kind of take away from this call when you think about your tax playbook as it relates to your exit. QSBS eligibility. How do you structure the deal with the entity that you currently have? Should you be thinking about those the estate planning, transfer shares before a sale, trust scenarios? How will structure be treated in my transaction? And there's a variety of different structures to discuss as well. And then where your state tax exposure might lie. And then finally, again, you have to be modeling for your net proceeds, right? All of these things have to come into play here. It's not just about what you're selling the company for and the price, but not just the gross opportunity, but the net opportunity as well. And if you're prepared to understand what those numbers are, you're going to be in a much better position to go out and sell the business. Your expectations will be in line with the market, and you know exactly what you need to achieve in the deal, right? And so very, very important that you consider this stuff now, not later. And hopefully you guys have taken away something from this, which we can, again, go a bit more in depth on. And Jeff, I know you wanted a few things to wrap up as well.
Yeah, just a quick parting thought. 40 million from that previous slide. Let's just say you had 5 million in earnings. So 40 million is the magic number because you're thinking 5 or 6 or 7x is industry standard on a sale price. My business is better, so it should go for 8. That's all well and good. I hope that happens. But I also think it's worth discussing what you're going to do with that money and matching up that amount of net proceed to what you're doing in your life. Like, it's very rare that a business owner can tell me what their short and medium and long-term goals and liquidity needs are. So that's another thing that's worth talking about, like less of the quantitative and more of the qualitative, which we would say is what we call the whole person approach, where we want to know what's going on in your life. And then often as a result of that exercise, you might be able to sell for 30 million if you have larger net proceeds and you've made a financial plan to realize, actually, even if I don't get a premium valuation here, this is still going to work for me and my family, which, removes a lot of stress in knowing that you're free and secure.
Indeed.
We have a few questions here that
great.
I wanted to run up with you guys. So is there a point where it becomes too late to implement some of these tax strategies before a sale?
Yes. Again, going back to the QSBS, Jeff, you want to remind everybody the timeline there, the 3 to 5, and how important it is to have that restructure done or the C Corp in place?
Yes. So if you originally structured as a C Corp and you've done it for 5 years, then you can be eligible depending on the type of sale. If you're thinking about a restructure, then you would want to do that 3 years before you sell to at least get 50% of the exemption, which is now up to 15 million or 10 times your basis. So I don't mean to drop a big nugget in right at the end here, but if you restructure and then sell 10 million to yourself into the new entity, and then it ultimately gets to a valuation of 100 million, you could get a full exemption on that whole 100 million. So that's where the restructuring becomes exciting, but at least 3 years in advance, preferably 5 on the QSBS.
Yeah.
And then there's a few things to know in terms of trust structuring that you would want to do probably 6 or 12 months before you think you'll have an LOI.
At least.
Yes, at least. But different cutoffs for different strategies. And let's call it at least a few years to be safe.
Yeah, and the last thing too, Tim, on the relocation, right? That depends on, to Jeff's point, your lifestyle, your life, family, and everything else, right? That's a massive decision that will impact a lot of people, and that should be done well in advance.
Yeah. Okay.
Yep.
The second one here is, what are the most common mistakes you see that cause owners to lose money at the exit?
As it relates to taxes? Yeah, I just think they're coming back to one of our slides here. Deal structure, consideration around the type of deal it is and how it would be structured. So knowing that and then modeling for those scenarios as you get into the deal process, to me, is the biggest one. And obviously that relates to taxes, but if you, again, go into the process with your eyes wide open, understanding and informed on all the different scenarios and how that impacts your taxes, there are levers you can pull or not pull just on the structuring of the deal. That's where I see things break down the most, Tim, in terms of actually getting deals done. And that has, again, direct impacts to just the tax liability in general.
Okay.
So structuring the transaction.
The last one here I think is obvious is what can you do today to prepare? And I think the answer is call Jeff, and we'll have the contact information down below.
Yeah, and just getting informed. Like these tools and these strategies we've discussed are in the market, right? Doing some simple searches to get a better understanding of the rules and eligibility requirements and what needs to happen. Gets high level informed, but in terms of the technical detail and planning, 100%. Get with the advisors that we talked about on that last slide in terms of your advisory team and get to work. It's never too early, Tim, as we always say.
Yeah. All right. Thanks, everyone. Thanks for joining. If you're watching this on YouTube, please like, comment, and subscribe. Follow along. We're doing this M&A series throughout the year, and we're going to be dropping more of these value bombs. If you're interested in exiting, whether now or a few years down the road, it's never too early to plan. Thanks, guys.
Thanks, Tim. Thanks, everybody.
Thanks, everyone.
Bye-bye.